morning, ladies and gentlemen. It's a pleasure presenting at this conference. Today I will be discussing investment migration, the umbrella term for residence and citizenship investment programs, and its growing importance as a vehicle for foreign direct investment. Investment migration programs have gone mainstream, with the majority of developed nations now offering pathways for investors to acquire residence rights in exchange for an economic contribution. Far from being limited to small economies, all 19 sovereign countries in the G20 offer mechanisms to encourage inward investment in exchange for residence rights. And most European Union member states provide non-nationals the right to reside in return for making an investment, including the big programs in Portugal, Spain, Italy, and Greece. The rationale is consistent across the board, attracting foreign capital, skills, and expertise to stimulate domestic growth. In the current global landscape, bolstering economic activity is an absolute imperative for governments. Let's consider some of the tangible economic benefits investment migration programs reliably deliver. First of all, an expansion of the local business ecosystem. Second of all, enhanced liquidity across commercial banks. Broad-based job growth, both directly and indirectly. Fresh revenue streams via duties and taxes on imports, and upticks in tourism. These benefits tend to be cumulative and reinforcing. They create interconnected positives such as increased tax revenues, infrastructure development, better fiscal performance, and reduced dependence on debt and aid. Investment migration programs provide governments with the means to generate sustainable value and liquidity without the downside of increased debt or deficits associated with traditional funding mechanisms. Thus, we refer to them as sovereign equity instruments. Investment migration programs effectively function as marketing and income-generating platforms to drive sustained foreign direct investment. For investors, especially those obtaining EU residence rights, the advantages are manifold. Intra-EU mobility, access to top-tier education and healthcare, business-friendly environments, visa-free Schengen travel, and an overall higher standard of safety and stability. Malta, the country of Malta, is a shining example of how investment migration can boost sovereign equity. In the years following the launch of its first citizenship by investment program in 2014, Malta had one of the highest growth rates and lowest unemployment levels in the EU. Pre-pandemic, it was the bloc's best-performing economy by almost any measures. And the results speak for themselves. Between 2015 and 2021, Malta's individual investor program, so the country's citizenship investment program, attracted more than 1.1 billion euro in contributions, 320 million euro in property purchases and rent, and 220 million euros in government bond investments. It's no coincidence, therefore, that Malta has reported annual budget surpluses for the first time in decades. Looking ahead, countries without proactive investment migration strategies will find themselves at an increasing disadvantage in the escalating global contest for capital, talent, and wealth. Romania, having recently joined the Schengen area, is well positioned for establishing an investment migration program that would result in inward investment and growth for the country. Thank you.
Thank you very much.